If you are 65 or older, there is a new deduction on your federal tax return that did not exist 2 years ago, and it could lower your tax bill by several $100s a year. It is called the senior bonus deduction, and it is worth up to $6,000 per person, or $12,000 for a married couple where both spouses qualify. This is not a tax credit you have to apply for separately, and it is not something a salesperson needs to sign you up for. It is built directly into the tax return you already file every year. The challenge is that most people have never heard of it, the rules around it are a little more complicated than they first appear, and it will not last forever. Today, we are going to walk through exactly what this deduction is, who qualifies, how the income limits work, how it stacks with deductions you may already be claiming, and what mistakes could cause you to miss out on money you are entitled to. Before we go further, a quick note on credibility. Everything in this video is based on information published directly by the Internal Revenue Service, along with reporting from established financial publications. Tax rules can be detailed, and individual situations vary quite a bit depending on your income, your filing status, and your state. Nothing here replaces a conversation with a tax professional who can look at your actual return, but by the end of this video, you will understand the basic mechanics well enough to know what questions to ask and what to look for when you file. So let's start with where this deduction came from. It was created as part of a tax law passed in the middle of 2025, sometimes called the One Big Beautiful Bill Act. Tucked inside that law was a new tax break aimed specifically at older Americans. Unlike a lot of provisions that take a year or two to kick in, this one applies starting with the 2025 tax year, meaning it shows up on the return you file in early 2026 covering the 2025 calendar year, and it continues through the 2028 tax year. After that, unless Congress acts to extend it, the deduction goes away. So you are looking at a 4-year window, 2025, 2026, 2027, and 2028. Now, who actually qualifies? The basic rule is that you must be 65 years old by the end of the tax year you are filing for. For your 2025 return, that means you needed to turn 65 on or before December 31st, 2025. If you are filing jointly with a spouse, each spouse who is 65 or older can claim the deduction separately, which is how a couple can reach the full $12,000 figure. If only one spouse has reached 65, the couple would generally qualify for $6,000, not $12,000. There is also a requirement that you include a valid Social Security number on the return, and if you are married, the law requires you to file jointly to claim this particular deduction. Married couples who file separately do not qualify for it. Here is something important to understand, because it is widely misunderstood. This deduction does not eliminate taxes on Social Security benefits. You may have seen headlines or heard claims suggesting that Social Security income is now completely tax-free for seniors. That is not accurate. The law did not change how Social Security benefits are taxed. What it does is give you a larger deduction that reduces your overall taxable income, which can, for some people, indirectly reduce how much of their Social Security ends up being taxed. But it is a deduction against your total income, not a special carve-out for Social Security specifically. Getting this distinction right matters, because if you go into tax season expecting your Social Security check to be entirely untouched by taxes, you may be surprised when you actually sit down with your return. Let's talk about the income limits, because this is the part that trips people up. The full $6,000 deduction is available to single filers with a modified adjusted gross income, often abbreviated as MAGI, of $75,000 or less. For married couples filing jointly, the full $12,000 combined deduction is available up to a modified adjusted gross income of $150,000. If your income is above those thresholds, the deduction does not disappear immediately. Instead, it phases out gradually, shrinking by about 6 cents for every dollar of income above the limit. For single filers, the deduction phases out completely once income reaches around $175,000. For married couples filing jointly, it phases out completely around $250,000. So if your income falls between those lower and upper numbers, you likely still qualify for a partial deduction, just not the full amount. Let's walk through what that phase-out actually looks like in practice, because the phrase phases out gradually can sound vague until you see it applied. Suppose a single filer has a modified adjusted gross income of $85,000, which is $10,000 above the $75,000 threshold. The deduction is reduced by roughly 6 cents for every dollar over that line, so you would take that $10,000 excess and multiply it by 6%, which works out to a $600 reduction. Subtract that $600 from the full $6,000 deduction, and this filer would still be able to claim a deduction of about $5,400. Now compare that to someone right at the edge of the phase-out range, with income closer to $160,000. That person would see a much larger reduction, leaving only a small fraction of the original $6,000 available. The further your income sits past the threshold, the smaller your deduction becomes, until it reaches zero at the upper limit. This is also a good place to mention how these figures may shift slightly in future years. The IRS routinely adjusts many tax figures for inflation, and while the core structure of this senior deduction, including the $6,000 and $12,000 maximums, was written into the law at fixed amounts, related figures like the existing additional standard deduction for seniors do get adjusted annually. For the 2025 tax year, that existing additional standard deduction is $2,000 for single filers and $1,600 per qualifying spouse for joint filers. Looking ahead to the 2026 tax year, that particular figure is set to rise slightly to around $2,050 for single filers. None of these small annual adjustments change the core $6,000 bonus deduction itself, but they are a reminder that your total combined deduction each year will not be perfectly identical from one year to the next, even if your income stays the same. This is a good moment to explain modified adjusted gross income in plain terms, because that phrase gets thrown around in ways that confuse people. Your adjusted gross income is essentially your total income from sources like wages, retirement account withdrawals, pensions, and a portion of your Social Security benefits after certain adjustments are subtracted. Modified adjusted gross income adds back a small number of specific items to that figure for the purpose of certain tax calculations. For most retirees without complicated investment situations, your modified adjusted gross income will be very close to the adjusted gross income figure already listed on your tax return from the prior year. If you are unsure where you fall relative to these thresholds, this is exactly the kind of detail a tax preparer can calculate precisely using your actual numbers rather than rough estimates. Now here is one of the more valuable features of this deduction, and it is something that makes it different from a lot of other tax breaks. You do not have to itemize your deductions to claim it. Most Americans, including most retirees, take what is called the standard deduction rather than itemizing individual expenses like mortgage interest or charitable donations. In the past, many special deductions were only available to people who itemized, which left standard deduction filers unable to benefit. This senior bonus deduction works differently. It is available whether you itemize or take the standard deduction, which means the majority of retirees who simply take the standard deduction can still claim this benefit in full. This brings us to how the deduction stacks with other senior tax benefits, because there is more than one. For years, the tax code has already included an additional standard deduction amount specifically for taxpayers who are 65 or older. For the 2025 tax year, that existing additional amount is $2,000 for single filers and head of household filers, and $1,600 per qualifying spouse for married couples. This new $6,000 bonus deduction does not replace that older benefit. It stacks directly on top of it. So a single filer who is 65 or older taking the standard deduction could be looking at the base standard deduction of $15,750, plus the existing $2,000 additional amount for being 65 or older, plus the new $6,000 bonus deduction, for a combined standard deduction approaching $24,000. For a married couple where both spouses are 65 or older, the combined number can be considerably higher than that. Let's make this concrete with an example, because abstract numbers are hard to hold on to. According to an analysis cited by AARP, based on figures from the White House Council of Economic Advisors, the new deduction is expected to provide an average benefit of around $670 in reduced taxes for eligible households. That is not life-changing money on its own, but stretched across 4 tax years, from 2025 through 2028, that adds up to roughly $2,700 in cumulative savings for a household that qualifies for the average benefit each year. For some households with higher deductible expenses or specific income situations, the savings could be larger. For others closer to the phase-out thresholds, it could be smaller. The exact number depends entirely on your bracket, your income, and your filing status, which is exactly why this is worth reviewing with your own tax documents rather than assuming a single number applies to everyone. There is also an interesting strategic angle here for retirees who do some planning around their income each year, because this deduction effectively shelters $6,000 of additional income from federal tax. Some financial planners have pointed out that it can be used thoughtfully alongside other retirement decisions. For instance, someone considering converting a portion of a traditional retirement account into a Roth account, which normally creates a taxable event, might find that the new deduction helps offset the tax cost of a modest conversion. Similarly, someone who has been sitting on investments with unrealized capital gains might use part of this deduction to absorb some of that gain at a lower net tax cost. These are not strategies to attempt without professional guidance, since they depend heavily on your full financial picture, but they illustrate that this deduction is not just a passive number on a form. It can factor into broader decisions about how and when to draw down retirement income during this 4-year window. So how do you actually claim it when you file? If you use tax preparation software, this is largely automatic. When you enter your date of birth, the software identifies that you are 65 or older and applies your eligibility automatically, generally without requiring any additional action on your part beyond confirming your information is correct. If you work with a tax preparer, they will handle this as part of preparing your return. If you file a paper return yourself, you will need to check the box on the form indicating that you are 65 or older, and the deduction itself is calculated and claimed on a specific IRS form called Schedule 1A, which was created specifically to handle this new deduction, along with a few other provisions from the same 2025 law. Schedule 1A then feeds into your main Form 1040. A few practical things to watch for. First, double-check that your Social Security number on the return is accurate and that it qualifies as work authorized, since that is a stated requirement for claiming this deduction. Second, if you are married, remember that filing separately disqualifies you from this particular deduction. So that is one more factor to weigh if you and your spouse have historically filed separate returns for other reasons. Third, keep an eye on your modified adjusted gross income each year during this 4-year window, particularly if your income fluctuates due to required minimum distributions from retirement accounts, since crossing into the phase-out range could reduce the deduction in a given year, even if you qualified for the full amount the year before. It is also worth mentioning who tends to benefit most from this. Based on how the income thresholds are structured, this deduction is aimed primarily at low and middle-income seniors, with the benefit shrinking for higher earners and disappearing for those well above the thresholds. If your household income from all sources is comfortably under $75,000 for a single filer or $150,000 for a married couple, you are very likely looking at the full deduction amount. If your income is higher than that, it is still worth checking exactly where you land, since a partial deduction is still real money. Let's address a few questions that tend to come up once people understand the basics. One common question is whether you need to do anything differently if you are still working part-time after 65. The answer is no. This deduction is based on your age and your total modified adjusted gross income, not on whether you are retired. Wages from part-time work count toward your income just like any other source, which means continuing to work could push some higher earners closer to or past the phase-out thresholds, but it does not disqualify you from the deduction itself as long as your income stays within range. Another frequent question involves what happens if you turn 65 partway through the year. The rule is based on your age as of December 31st of the tax year in question, not the date you actually turned 65. So if your 65th birthday falls any time during the calendar year, even as late as December, you are treated as 65 for that entire tax year and qualify for the full deduction, assuming you meet the other requirements. There is no prorating based on how many months you were actually 65 during the year. People also sometimes ask whether this deduction interacts with required minimum distributions from retirement accounts, which generally must begin at age 73 or 75 depending on your birth year. A required minimum distribution counts as taxable income and gets added to your modified adjusted gross income for the year you take it. If a large required distribution pushes your income up near or past the phase-out thresholds, it could reduce or eliminate your eligibility for the senior bonus deduction in that particular year, even if you qualified easily in prior years. This is one of the reasons some retirees work with a financial planner to think about the timing and size of withdrawals across the 4-year window this deduction is available, rather than treating each year in isolation. One more point on durability. Tax provisions that are described as temporary do sometimes get extended, and sometimes do not. Right now, this deduction is scheduled to expire after the 2028 tax year. Financial commentators have noted that because the deduction has proven popular, there is a reasonable chance lawmakers could extend it before it expires, but that is speculation about future legislation, not a guarantee. The responsible way to think about this deduction is to treat the 4 years currently on the books, 2025 through 2028, as the window you can count on, and treat anything beyond that as a possibility rather than a plan. To bring this all together, here is the core of what to remember. If you are 65 or older, there is a new federal deduction worth up to $6,000 per qualifying person, available for tax years 2025 through 2028. It applies whether you itemize or take the standard deduction. It stacks on top of the existing additional standard deduction for seniors that has been around for years, and it phases out gradually for single filers with income above $75,000 and married couples filing jointly with income above $150,000. It does not eliminate taxes on Social Security benefits, but it can reduce your overall taxable income in a way that, for some people, indirectly lowers the portion of Social Security that gets taxed. Claiming it generally happens automatically through tax software or a preparer, or manually through Schedule 1A if you file on paper. If you found this breakdown useful, the most helpful thing you can do is pull out your most recent tax return, look at your modified adjusted gross income, and compare it against the thresholds we just covered, so you walk into tax season already knowing roughly where you stand. And if you know someone else who is 65 or older and manages their own taxes, sharing this with them costs you nothing and could help them claim money they did not know was available. As always, for anything specific to your own return, a qualified tax professional or a service like the IRS Volunteer Income Tax Assistance Program, which offers free help to seniors, can confirm exactly how these numbers apply to your situation. Thank you for watching, and I will see you in the next one.